around $2 to $3 billion over a 5-month period if and when India gets included in the Bloomberg Bond Index. All right, here you go. First tick on the index, very strong, up 130 points. The Nifty holding on strong above the 21,600 mark. The mid-cap index well in the green, flying off the shelf actually right now. And if you look at individual stocks, it's Bajaj Auto that's topping the charts, 5% higher on the back of the buyback. Tata Motors is up 1.5% as well, strong GLR sales. And IT stocks have come back. So Wipro, Infosys, LTI, Mindtree are all in the green. Metal stocks are not too bad either. Tata Steel is in the green as well. Auto stocks, Hero MotoCorp, along with Bajaj and Tata Motors are trending higher. So two-wheelers are looking pretty good. Apart from that, Titan, Cipla, Coal India, JSW Steel are a couple of other names that are trending in the green right now. Guess what? There is no Nifty stock in the red. So the sentiment is very, very upbeat this morning. The mid-cap index is soaring away. So all the action really is in the mid-cap space, and Nigel will take us through that. But the advanced decline ratio is also very comfortable at almost, I mean, it's not comfortable, it's rocking actually right now. 13:1 in favor of the advances, looking very good.
When Sonia uses the term rocking, it is indeed rocking. You know, from the broader markets as well, plenty of stocks that are rocking around. You have IRB Infra, December toll collection up close to around 26%. That's one of the top volume gainers as well, up close to around 5% as we speak. GMDC, they've got an environment clearance for one of those mines to increase capacity from around 3 to around 5 million tons odd. That's good for the lignite business, but I think the street is betting more on the other parts of the business. You know, what can they come up with in terms of rare earth minerals? That's the bigger trigger for the stock from here on. For the time being, though, up close to around 3.5%. What else doing well? Bandhan Bank, they said that there's no audit by the RBI, but a sample audit by CGFMU claims. Abhishek Kothari had brought us that story, and now the management is confirming that as well. So that's another big mover. What's not doing well? Zee, that's under pressure, down close to around 7%. Uncertainty on the merger, so that's why that stock is a little bit lower. And a couple of other big volume movers. You have Trident. That's one of the top volume movers on the NSE. That's up in today's trading session in the first couple of minutes. You have Jyoti Structures as well, another smaller name in there that's moving higher. So keep an eye out on the broader markets. Plenty of stocks that are moving around. The headline index is now up 150 points. And I'll tell you what, the Nifty Bank is holding at 47,750. We're 60 points away from the 20 DMA. You'll want to track that mark, 47,810, crucial mark for the Nifty Bank as well.
Okay, well, so it's a good-looking screen. It's actually a fantastic-looking screen. 150 points on the Nifty is what we have now. And, the Nifty Bank is up about 0.6% or so, which is about 290 points. You know, the level to simply watch is yesterday's high. For the Nifty, that is 21,764. That is still 100 points away from where we are right now. But, you get to that, you stay above it. And it starts to look a lot better once again, price momentum wise, that will be true. Zee is bounced off a little bit off the lows, and you can see it at the bottom of the screen. I think at one point was down almost a full 10%. It's down about 7.8, 7.9%. Stocks at about 256. Big volumes on Zee at this point in time. Let's just take a look at a few other names before we sort of welcome in our market master. Trident, which went up, which was limit up yesterday. It's up another 8%. Stocks at about 52, but humongous volumes on Trident. Look at that, 50 million shares on Trident right now. These textile companies, Alok Industries is another one, 10% higher, 40 rupees. Again, volumes are humongous coming through there. I think maybe we can put up Sula. Sula on the downside, was limit up yesterday. It's down about 3%, pulling back a little bit. That's about it. I think we mentioned GMDC earlier, which is doing very well. Brigade Enterprises from the real estate space is coming up with volumes. It's got about a 5% gain. Stocks at 992. There is Punjab National Bank. It pulled back about 2-3% yesterday. It's coming back about 1.5% right now. Adani Ports was one of the top Nifty gainers yesterday. It's up another 1.6, 1.7% as the trading starts this morning. Just a few names on the downside. All Cargo Logistics is down 8%. Stocks at about 82, and there's a sharp cut coming through on All Cargo. And there's Zee Media, which is down about 6% or so as well. I mean, 16.5, but there are volumes. That's why I'm mentioning that. Colgate is another one, which is down about 1.6, 1.7%. So it's that kind of a start. More up than down. Market breadth looking pretty solid. And the Nifty, all in all, everything told, is up 130 odd points or so.
I just want to make a point on Zee, right?
Yeah.
The stock is taking quite a big knock right now. And as even Karan Karani was saying, this could be a long standoff.
Yeah.
I mean, Sony not wanting Puneet Goenka to be CEO and, the Goenka standing their ground. So things are getting really murky, especially in the last couple of months. And in terms of a timeline, so if you're a shareholder of Zee, for example, you don't know which way this is going to head because nobody wants to, change their stance.
Yeah, Karan, of course, clearly believes that this is more than anything else posturing. He's clearly saying that this will go through and it'll take a month, 2 months. But it's a binary kind of an event.
Knows,
we don't know.
Right? I mean, nobody knows. It's just a guess that you're taking. Your guess is as good as mine sort of situation.
No, that's what, but he's making that bet. Let's see. 9% lower is what we have and very large volumes at this point in time. Gautam Dugat is with us. He's our market master of the day, head of research institutional equities at Motilal Oswal Financial Services. Gautam, best wishes in the new year. Thanks very much for being here on CNBC-TV18. Prashant this side. Let's just kick it off with earnings. And, I was looking at the earnings preview, so the detailed note which you guys put out. And I just want to begin with IT services because there has been so much talk and debate about what now. Stocks presumably have moved up even before recovery there has started. What should we expect in the third quarter from IT services and what would you want to hear from companies? Because results we will get from Infosys and TCS on Thursday.
Hi, good morning, Prashant and Sonia. Happy New Year to you and your viewers. Thanks for having me. Yes, this quarter is going to be a bit lackluster and given the fact that you have more furloughs this time and the commentary which has come in, from the other companies too over the last 3-4 months, the expectations are really muted, Prashant, so much so that, just statistically, this is the first quarter after 26 quarters where we are expecting a YOY decline in IT earnings. It's not much, it's just 2%. And if any big company reports a slightly better other income, it might even turn out to be a flattish quarter. But yes, at least in the preview, the number that we're expecting is a minus 2-3% kind of an earnings print. But besides number in IT, what always matters is the guidance, what kind of commentary they have for FY25. Maybe it's not the right time for the companies. They may not speak much about FY25, but some clarity and visibility on the demand will definitely help because we have seen big companies cutting guidances multiple times over the last 8-9 months. I remember when we started the year in April, our expectations for IT for FY24 was earnings growth of 10-12%. And as we are in January now, that expectation has gone down to just about a flat number for FY24 over FY23. So some bit of visibility on demand will definitely help. Margins are fine, I think, for IT sector. They're normalized after the pre-COVID levels. But demand is something which constantly remains a worrying factor, especially in the large cap IT, because mid cap IT seems to have done reasonably well over the last 2-3 years. Some of them are at crazy valuations also. But yes, to answer your specific question, the demand visibility is something which I think most of the street will be glued to.
Okay. Gautam, hi, good morning. I want to talk about the auto sector because in your note you mentioned that BFSI and the auto sector will continue to lead. And you have some of your top picks in that sector, including names like M&M, etc. But I want to know that the rally has been quite swift, right, in the last 1 year. Do you see even spaces like two-wheelers, for example, build on to these gains this year?
Looks like so, Sonia, because auto sector has come back into reckoning after a very flat earnings for 5 years. In FY18 to FY23, the Nifty auto earnings remained flattish. In between, they went up and down, but it ended FY23 exactly at the same point where the FY18 earnings were. And then in FY24, we have seen earnings go up 100% for auto sector. So from 28,000 odd crores to 57,000. And the rally that you mentioned in auto sector is partly a reflection of what has happened to the underlying demand, margins, and consequently the earnings growth. As we step into FY25, obviously this large base will play some spoil sport in a overall aggregate scenario. Our expectations for full year FY25 is 10% growth. But yes, for the quarter, that is third quarter FY24, we are building in a 35% growth in auto sector earnings with decent margin expansion. Auto volume numbers are already there, they have been disclosed. So as far as the sector is concerned, from our model portfolio stance, we moderated our overweight there. We are largely equal weight now. So about a year back, we had close to 200, 300 basis point of an overweight on auto. Now it is a bit more flattish, equal weight kind of a scene, with M&M and Hero being our top idea, as you rightly mentioned. Two-wheeler, obviously, there is clear positive shift in demand patterns over there, as we've witnessed over the last 2 quarters. While the festive season has not gone down too well, as one would have imagined or envisaged a couple of months back, but the valuations for two-wheelers, specifically both Hero and Bajaj, are still kind of okay, in the sector. And on four-wheeler, our preference for a long time has been with M&M.
Okay, all right. Hi, Gautam. Good morning and good to see you in. Wishing you a cracking 2024, Gautam. I wanted your view on the domestic-facing themes. They have really been the way to play this market. But getting into an election year, maybe we'll see some order intakes that will slow down. Some of these companies could see a bit of a slowdown in terms of order intake. How do you approach them? Do you believe some of them still offer good opportunity? Because the problem is in the last year, as orders started coming in, market capitalization more than reflected that. Your view?
Nigel, hi, Happy New Year. But Nigel, that's how this sector has always behaved in cycle, right? Sometimes the stock prices or market caps anticipate what is going to happen in the order books, and it discounts it too fast. And that is exactly the situation we are in right now. If you look at the kind of market cap creation which has happened in industrials, defense, power, all those kind of sectors in the last 18, 24 months, obviously the business has not kept pace with the market cap growth to that same extent. So a lot of the good news is already there in the price. But the sector has come back into the reckoning after almost a decade of going nowhere. And there are many sectors like that, in industrials being one, power being another one, real estate, utilities. These sectors had been forgotten from 2012 to almost 2020-21. It's only in the last 2 years you're seeing some buoyancy happening there, and for the right reasons. The order book creation, the capex creation, infra as a theme, PLI as a theme, manufacturing as a theme, all of them are coming together. And that is what is resulting into a lot of positivity around the capex theme for this country. We've seen government leading the capex earlier part of the cycle. Now there are hopes and some sort of signs that private capex will also follow. The problem, Nigel, in this sector is of valuations, right? We are positive on this space. We have a big overweight there. We have added ABB also. We have Kirloskar Oil and L&T. We've been holding a big position for a long time now. We've also increased our weight in real estate big time from 1% to almost 4% now. So while we are positive, we are fully cognizant of the fact that valuations are quite rich and companies will have to deliver on execution because the price for not delivering, given where valuations are, can be quite brutal.
All right. Well, I just want to point out that there are a lot of stocks which are moving around right now. GMDC has picked up quite a bit of pace. I think I checked out, it's a 10% rally that we're seeing on GMDC right now. And of course, there have been a lot of, reasons, positive updates coming in over there. They've received their environmental clearance for the capacity expansion approval from 3 million tons per annum to 5 million tons per annum. So as even Nigel was highlighting earlier, so GMDC is a big mover, 10% higher now.
GMDC, Sonia, is one of those stocks. Any bit of good news will be very, very good. I believe, I'm just trying to get further details, but this expansion that they got actually from this particular mine, there's not much output as of now, though they've got an expansion. So any trigger of good news, we see the stock flying away because the street is so optimistic out there. So let's see how this goes. But I think the bigger trigger for them is how their volumes ramp up with regard to the lignite business and what kind of an opportunity the rare earth minerals. For the last, I think, 2 years, we've been talking to the management. They're saying they're working on it. So we'll have to see numbers coming out of there as well. For the time being, I remember we covered the stock 2 years ago, 135. Now it's nearly 500 rupees.
One of those,
the kind of positive rub off the kind of interest in the stock.
Interest in the stock, and it's created a lot of wealth for shareholders. So that's a good thing. But Gautam, I was going through, since we're talking mid caps, right? Let's take a look at your portfolio as well. One of the stocks that you've liked is this entire consumption space. So whether it's Zomato, whether it is Indian hotels, a couple of others in this space as well, Lemon Tree Hotels. Do you think the hotel space has become a little bit of a crowded trade now? Because anyone and everyone knows that there are some big events underway now with this whole Maldives situation as well. Lakshadweep is picking up in a big way. There's the Ayodhya launch that's happening later this month. the Ram Mandir opening. So do you think a lot of this has been priced into the hotel space, or do you think there's more to go?
Sonia, yes, it will be foolish to disregard the fact that a lot of that is already in the price. But also fact remains that this is a sector which has seen a big downturn for almost 10 to 12 years after 2008 to 2020. Possibly we are in the second or third year of an upcycle. And I think this upcycle can last few more years because your supply in a basic, it's not a commodity sector, but it's a cyclical sector. In a cyclical sector, supply always has a very important role to play in the pricing and does the operating leverage and consequently the market cap creation. Right now, where we are sitting, it looks quite conceivable that for the hotel sector, the demand-supply dynamics can remain in favor of the hotel players. And given the fact that you're seeing explosion of demand in the domestic side, given the events of the last few days, and also the fact that a lot of events have taken place in CY23, some of them could continue in CY24. I think ARR, occupancy, RevPAR, a lot of those parameters are still giving you green signals on hotels. So we will remain very constructive here, which is why we've been holding both the hotel stocks in our model portfolio for more than a year and a half now. And some of them are also part of our CY24 top ideas.
All right, Gautam, we will leave it at that. But I request you to listen in for a tad bit. We're having the management of Bajaj Auto to talk about their buyback, right? They announced a massive buyback. So we'd like you to stay back, listen in, and maybe even give your thoughts at the end of the discussion. Bajaj Auto is one of the biggest gainers right now. There's a 4,000 crore buyback that has been approved at a price of 10,000 rupees per share. Nobody expected that. That's a 43% premium to yesterday's closing price. Dinesh Thapar, the CFO of Bajaj Auto, is joining us now to talk about that. Mr. Thapar, good morning. First, if you can explain the rationale behind such a big premium on the price and also, what the plan is going ahead.
Morning, Sonia. So, the board approved a buyback of 4,000 crores, as you rightly pointed out, at 10,000 rupees a share. So essentially about 4 million shares that we are looking to mop up as part of this buyback. It's about 16% of our paid up share capital and free reserves. And therefore, this is subject to shareholder approval. And we'll run through that process between now and the middle of February. But coming into the rationale, Sonia, and I know it may have taken many by surprise, but look at when we discussed this at the board yesterday, what we had was one marker, which was essentially looking at a history of precedent transactions that have happened, which suggested that normally price premiums range anywhere between 25 and 30% over prevailing price. And that was one marker that the board could have taken a very mathematical view about it and said, let's apply anywhere in the ballpark of 25 and 30%. But what the board chose to do, and we reflected on this and had an extensive discussion at the board, was to really use this as an opportunity to reflect on our performance over this last little while, which has really been quite compelling and really outperforming in terms of the broader industry. But as much from a point of view on the outlook for this business as we look ahead, and therefore how does that in turn reflect into the valuation of this business? And that's how we arrived at the 10,000 crores. And let me give you a little bit of a sense of the underlying thinking and why we feel confident of putting that price out over there. So I think if you look at the two-wheeler business, it's weathered a perfect storm over the last few years. And I think things have now started to look up over the last 12, 15 months. Clearly, a lot of the pricing of the product that was a challenge that saw demand get dampened is now coming back. Affordability is coming back in a big way. The markets are relatively buoyant, and we've seen that reflected in the commentary of ourselves and across the broader industry. There's a transformation that's underway in which Bajaj Auto is playing a fair share and really investing quite substantially. And then there is, of course, the commodity markets, which are relatively stable, which augur well for us to be able to drive operating margin and profitability whilst making very competitive investments. So when you look at the broader industry, I'd say a very compelling outlook in terms of where we stand. Now, against that, if you look at Bajaj Auto in particular, I think we've got a business now which is firing on all cylinders. Our domestic business, starting over the last 15 months, has been on momentum, on song, in motorcycles business. Take every part of it. In the motorcycles business today, the strategic segment of the 125cc, which is really where we've got much of our focus on, we've been growing ahead of market, we've been growing share. And in December, you would have heard and noticed that we've clearly taken pole position. So we're now the largest 125 plus cc motorcycle player in this country, right? And there's much more in the offing on that front. The addition of Triumph to the portfolio, very exciting, clearly can provide a fillip to potentially double our premium motorcycle business over the next few years in the short term, and clearly much more as we look even forward. And it opens up an export opportunity on that front as well. When you look at our commercial
Sure.
vehicles business, really, we've restated that. And, now with the addition of the E3 wheelers, which has been well received, that opens up a whole new vista of opportunity for us. And on
Got it.
electrification, E2
Dinesh?
wheelers, clearly so much more.
Absolutely. No, that's great to hear that the fundamental performance has improved quite a bit. Just on the buyback, I wanted a couple of more details. Why did you decide to do just 1.4% equity? Why was it such a small amount? Is there any rationale behind that? And also, will the promoters be participating in the buyback? If yes, what will the stake be post?
So, Tonya, we've picked 4,000 crores, clearly a strong balance sheet, and we would have ended the year in the ballpark of about 20,000 crores of cash. We had our last published balance sheet in September. We were at 17,500 crores then, having added about 3,500 crores of free cash flow in the first half of this year. I'm not in position to share with you what are three numbers, but if you just extrapolate that, we'd have ended off with about 20,000 crores. Our performance so far in FY24 is clearly ahead of expectations. We did 3,500 crores of PAT in the middle of the year, and if you extrapolate that into the full year, that gives you a sense that we could be anywhere between 25 to 30% over the last year, which was essentially 5,600 last year. And so therefore, that provides headroom for a larger buyback size. We did 2,500 crores last year. And the intention is to do 4,000 crores of consideration this year, Sonia. But when you look at it in terms of an outlay, there's another 1,000 crores that will go behind buyback tax and transaction costs. So essentially, we'll be spending about 4,950 behind this buyback. And then, of course, the intention was to really come in with a size which was larger than last year, which is the 2,500 crores, essentially to take cognizance of the fact that we've got stepped up performance and a bigger year in play for us over here. So that's really the 4,000 crores and the reason why we opted for that. Strong balance sheet, stepped up performance, and a bigger PAT pool, which allows us for a higher distribution. The promoters will participate, and that's what we've put out as well.
Okay, so the promoters will participate. So currently, promoters hold about 54.9% stake. What will the promoter stake be post the buyback, and what is the promoter stake expected to be at over, say, the next 1 to 2 years?
Yeah, so Sonia, if we simulate this, the promoters will not end up diluting because we think, with the current pricing that we've put out, it presents a very compelling proposition for investors and shareholders to really make their full entitlement. And therefore, if that was to be the case, the promoters will tender in line with their entitlement. To that extent, I expect post buyback shareholding for them not to be diluted. In fact, it might creep up slightly because we've also got a 15% reservation for small shareholders over here. So when you do the maths on a post-buyback percentage, the promoter holding, assuming everyone tenders in line with their entitlement, should be at about the same levels or a tad higher.
Dinesh, hi, good morning. Prashant here. It's I don't know if congratulations is the right way to begin, but 10,000 is a big number and shows confidence, right? Although you're, it does. And thanks for explaining the rationale pretty well. I just had two sort of points that I wanted to address. One is, the capex requirement, because you're investing into new segments, EVs, etc. What is that likely to be? If you can give us some color. And second, you did briefly mention the under 125cc segment. The 125 plus cc, I think now you got 35% plus kind of share. But at the lower end, what are the trends you're seeing? Because that is a segment which has been hurting. The premium end is doing just fine, and you're doing exceptionally well. Go on.
So let's take the second question first. So I think, for a period of time, we've now been saying our strategic focus has been in growing the 125cc segment. There is a shift that is structurally happening year after year in favor of the 100, 110cc moving up to 125. We are well positioned in that space. Pulsar is clearly leading. Our brand Pulsar is clearly leading in that space. And I just did mention that we've now taken pole position and are the largest in that space. If you look at our performance in this last little while, because the volume numbers are out in public domain for the last quarter, we've grown overall at 2x over the industry. It is a bit of a dilution that we have on the 100, 110, or the M1, M2 as the market calls it. But we've grown significantly ahead of market, over 3-4x on the 125cc plus to allow us to grow 2x in line with the overall market. So that's how it is. Demand in December, which really was the month after the big festive season or the big Diwali and Dussehra held out. And so we've done quite well, and you see that reflected in our Q3 numbers.
All right. Hi, Dinesh. Nigel on this side. Congratulations. Good going for your shareholders. And as a consumer and as a rider, I enjoy riding the new bikes that you're putting out. And as I asked Rajiv as well, hopefully we'll see even bigger bikes coming out of Bajaj Auto. But, I want to focus on the electric vehicle space. We have Mr. Sharma that joins us on a monthly basis. Rajiv as well was talking about that number moving from around 10,000 to around 15,000. Now, there's value unlocking that people are talking about. At a particular point of time, could this be carved out into a separate entity, the electric vehicle space? Because we have seen you outpacing the market growth out there as well.
Yes. Yes, Nigel, and I think very pertinent observation. I think when you look at how we've progressed on the electric two-wheeler business, we've taken short but steady steps to really build out our business. If you rewind to 12 months back in the league tables, we'd have been number 7, number 8. Today we're at number 3, and the ambition most definitely does not stop there. We're continuing to invest, and you will see the funnel of innovation is clearly well populated, and I think over a period of time you will see a lot of that being brought to market. Clearly, a lot of work that's happening on the cost front as well. So I think all guns blazing in terms of building out our capabilities on winning, in the electric two-wheeler space. We've also got the electric three-wheeler, which I think, the market mustn't forget that is out there, that's been well received and has already started to receive a very strong response and has hit market leadership in the early cities that we've already launched in the first few months of already getting in over there. So a very strong emphasis on building out the electric business, Nigel. We already have an entity in Chetak Technology that allows us possible flexibility on structures in the future as and when we choose to do it. But I think at this point of time, we're single-mindedly focused on really building and scaling up volume. We move from 3,000 units a month to 10,000. Next pit stop is to get to 15 and then possibly to 20. But the idea is to very clearly build volume, really build our capabilities in the space, and build a sustainable business model, which is really cost competitive and allows us for us to be able to expand without a significant drag on margin. The good thing is that we've got an ICE business which is on song at the moment at 20%, and therefore we're able to register 20% enterprise margin. But this is after coming on the back of investments that we are making in the electric business. So I think there's a fair amount of work that's happening over there. I think to a question that Prashant asked, our capex requirement is about 1,000 crores over the last couple of years. As we're stepping up, most of this investment is going behind really building facilities and R&D for our EV business, and of course, putting up a new factory that we did in Chakan for our Triumph business, and both potentially new revenue streams that can add significantly to Bajaj Auto's revenues as we look forward. So really on a free cash flow basis, we feel quite confident, and that therefore allows us to be able to make very significant payouts as we currently have done in the last year, where we paid out over 100%. And this year, we've already done a big buyback of about 5,000 crores of cash outlay.
In the next 2 to 3 years, could we see a separate listed entity, Bajaj Electric Vehicles?
I'm not going to comment on that. We have the structure that is out there, which allows us the flexibility to do that. But I think at this point of time, we single-mindedly focused on building out that business, growing scale, growing the network, putting out much more, which is already in the R&D product development funnel, and really growing our positions, our competitive positions in the electric space.
All right, Dinesh, it was a pleasure speaking to you, actually. We don't see you very often on the channel. We hope to see you a lot more because we got a lot of, interesting information, and I'm sure shareholders are happy to hear from you as well. All the best, and thanks a lot for joining in. That's Bajaj Auto, one of the big movers this morning, up 2%. It's 2% today, but if you just map the journey, right, in the last 6 months, the stock has given you a 50% return. Just look at that stratospheric move on that stock, doubled in the last 12 months. Slip into a quick break. On the other side of the break, Sivaram Krishnan Ganapati of Gokaldas Exports will be joining in to talk about the impact of the Red Sea tensions on their exports. Later in our special segment, Quarter Se Quarter Tak, Reema will talk about what to expect from the IT sector in Q3. Also, Kamaljeet Saluja of Kotak will be with us to discuss his expectations from the IT sector.
Okay, welcome back. The market's pulled back a little bit. We're, 100 points higher. We were up 150 when we started. 21,600 is where we are at. Now, textile companies have been doing very well. I mean, and a whole host of reasons behind it. And this actually, coming despite the fact that, when you talk about textile companies and apparel makers, exports is a large sort of component of their businesses. And shipping rates, etc., have gone through the roof, as we've been highlighting over the last couple of days. There are individual triggers for lots of these companies as well, and we're talking to one such company. Gokaldas Exports is what I'm referring to. We have Sivaramakrishnan Ganapathy, Vice Chairman and Managing Director of Gokaldas Exports, joining in right now to take some questions. Mr. Ganapathy, good morning. Great to have you with us here.
Good morning.
Wish season's greetings in 2024. First time I think we're speaking with you this year. Actually, we've not spoken with you, I think, for a while. And I want to begin with something that I wanted to ask you before we get into, the business intricacies, etc. There was a share sale by you, which happened some time back. The market, I guess, took that as a bit of a signal because that essentially was also the high, in a way, the top for the stock. At least, I mean, since that point on. And there have been other kind of factors affecting the stock price. It's not just that. But I just wanted you to explain what was the rationale behind it and, how much did you sell? What is your holding now? And what should we expect from here?
So I just sold enough to, repay my ESOP loan. So when I had exercised my ESOP to pay taxes, I had taken some loan. So I had this loan, overhang over me. So for that, as well as from, some personal loan for housing, etc., which I had taken, I just wanted to square off. But principally, what I sold was meant for paying back the ESOP loan that I had taken. So that was it. I still hold 10 lakh shares in the company. I have ESOPs worth another 8 lakh shares. So I'm all of that is intact, and I'm very much invested in the company.
No more share sales, Mr. Ganapathy? I mean, at least not in the foreseeable future?
No.
Okay.
All right. Hi, Mr. Ganapathy. Good morning. Nigel on this side. And wishing you all the best for 2024. Well, I wanted to ask you about this entire Red Sea conflict that's taking place. Has it impacted trade for you? And, could you tell us that the freight costs have moved up? So that will hurt you all as well?
No, it won't, because we usually do FOB business. So the customers aggregate all the goods and then pay for shipping. So they not only aggregate across India, but they aggregate across the region as well. So they have long-term contracts with likes of Maersk and others. So they bear the shipping cost. So from our perspective, the increase in shipping cost is on the customer's books, not on our books. So there is no impact whatsoever. On the contrary, because the shipping times have increased, some of the customers are asking for, advancing the deliveries a bit. So that we're dealing with. Some of them are also trying to airlift just to fill the shortcomings or shortfall in their warehouses. But it's being handled well between our logistics and their logistics. But at the moment, we're not incurring any cost. When it comes to imports, because we also buy raw materials, most of the imports come from the Far East, and that's not impacted by the Red Sea situation. So we don't have any import cost increases. And on the export side, since most of the goods go to the West, the costs are borne by the customer.
That's good to hear. So the costs are borne by the customer, so you don't bear any costs on your books. But given the kind of delays that we're seeing, the kind of perhaps pressure that the customers are facing, do you expect that this could have some impact on your own earnings? I mean, in any way, just trying to understand that, because the last time when we spoke to you, you told us that even Q2, Q3 earnings could continue to be under pressure before things improve. But how is the situation right now?
So when I look at, from an earnings perspective or brands perspective, I don't think, this will have any impact on their buying. Of course, it'll reduce their margins a bit, but I think they will also have adequate, negotiation power with the freighters. Coming to how the situation looked like for us, if I look at the order book going all the way up to Q1, I draw a lot of comfort. Things seems to be coming back. If I look at the holiday season sales, they were pretty okay and pretty decent in the West. And when I look at my Q4 and Q1, order book, it seems to be coming up well. So things are improving as we speak from a demand perspective. We'll watch how the US markets perform in calendar 24 and how the retail demand stays put during the year. But from currently what we see, it seems to be okay.
So can you give us a number on what the order book situation is right now and what is the expectation? And I think last time you said that you're looking at a 20% growth rate. By when do you think you could manage to eke that out?
I think from a FY25 perspective, I think we will be working towards that. So, I'm confident that, with all the initiatives that we've taken, we should be seeing pretty good growth in FY25 or FY24.
Okay, all right. Mr. Ganapathy, I don't want to ask you in the near term because you obviously will be in silent period, but you have capacities that are coming in stream. And I recall that, you were indicating that maybe you hit more or less the optimum utilization levels, optimum revenue levels by FY26. Give and take everything, how demand is shaping up, do you think Gokaldas Exports will be in that vicinity of closer to around 3,500-4,000 crores revenue by 2026?
It should be. That's the aim. 3.5 would be directionally where we think we will go. So that's kind of you're on the ballpark.
Ms. Ganapathy, just two questions. I mean, just to come back to that, you said your business is FOB, but would there be no negotiation asking you to share a portion of the burden as well? I mean, down the line, if this continues, no.
No, I don't think we will bear that. Given that how costs have functioned, etc. The freight is entirely on the customer scope, and we will not take that cost up on our books. So we haven't seen that happen in the past, and I don't foresee that happening in the future as well.
Okay.
If at all, there will be a negotiation between the freight, the freight companies or the logistics companies and the brands. They will negotiate, and they will try to see if the shipping companies can defray part of the cost or absorb it. It'll be a negotiation between the two. Right.
How's the big acquisition you announced a few months ago coming along? What's the latest? Yeah.
So we just concluded it. In fact, we got the regulatory approvals for most of the different assets. And we've taken control of the asset as of 3rd of January. So now it's very much part of Gokaldas Exports.
Got it. All right. We'll leave it at that. Thank you for joining us and explaining the business as well as the Red Sea situation. And seeing that it has no impact on your business at the moment. That's Gokaldas Exports. But the next big trigger to watch is the earnings season that's about to kickstart in just a couple of days from now. It's our special segment, Quarter Se Quarter Tak. Reema's joining in to tell us what to expect from the IT sector. Reema, over to you.
Thanks so much for that. In terms of numbers, Q3 FY24 is likely to be another weak quarter for the Indian IT industry. Two reasons for that: weak seasonality, higher than usual furloughs, and then again, the continuation of weakness in discretionary demand. In fact, according to a CNBC-TV18 poll, 4 out of the large 6 IT companies are likely to report a decline in their top line, all except HCL Tech and LTIMindtree, where you will see a bit of a growth. Now, if you look at the numbers, the losses are estimated to be steepest for Wipro at minus 2.4%, dollar revenue down on a quarter-on-quarter basis. For Infy, down 1.5% to 2%. TCS will be on the flattish side. It's HCL Tech and LTIMindtree which will buck the trend. HCL Tech growth seen the highest at close to about 4%, driven by a Verizon contract, a very large deal that they had earlier won, an acquisition of ASAP, and seasonal strength in their products business. While LTIMindtree is also going to show the growth this quarter, and they'd already guided that H2 will be better than H1. Now, on the important subject of FY24 guidance, and it is possible that revenue downgrades continue. In fact, Kotak and Ambit expect Infosys to further cut the revenue growth guidance. It currently stands at 1 to 2.5%. They're saying the upper end of the guidance could be brought down to 1 to 2%. GS and MS, that's Goldman Sachs and Morgan Stanley, also see Infosys trimming or, just narrowing its guidance band to 1.5 to 2%. Basically, the upper end of Infosys' guidance of 2.5% comes down to 2%. If that happens, this will be the third guidance cut by Infosys this year. Even for HCL Tech, JP Morgan is saying that we expect the FY24 CC organic growth guidance to be cut by 50 basis points to about 4 to 5% for the services business and 3.5 to 4.5% for the overall business. Now, Wipro gives you a quarterly guidance. You're going to be watching out for the Jan to March quarter, and it's expected to be another muted guidance from them. The range is -1 to +1%. Now, on FY24 margins, the guidance by both Infy and HCL Tech is likely to be maintained, according to most analysts. Now, let's tell you what the street is focusing on. Well, it's going to be commentary on demand revival. Investors want to see signs of year-on-year revenue growth bottoming out. What will CY24 budgets look like? Are there any green shoots in laggard sectors like BFSI, telecom, high-tech? Also, this quarter has seen fewer large or mega deal wins, which dominated the narrative in the first half of the year. So the deal win number, the TCV number, could look lower on a quarter-on-quarter basis. If you remember, this was also the quarter where Infosys had announced that a large $1.5 billion MOU, which was signed by the company with a global client, got terminated. Very unusual for a company like Infosys. And on Q3 margins, for most companies, it will either be flat or higher, barring Infy and Wipro, where margins are likely to decline on account of wage hikes. And finally, on Wipro, there has been a lot of news flow on the HR front. Senior level exits continue, legal suits, reports of the promoter being unhappy with the CEO. But despite all this, stocks have done well. From the last quarter to this quarter, we're looking at a 3-month performance, and it's been a double-digit return for a company like HCL Tech. Even Wipro or even Tech Mahindra has actually clocked in a double-digit return in the last 3 months. So now on the subject of valuations, no longer very cheap, still not at the premium peak valuations, but it's a 27 times forward multiple for TCS, 23 times for Infosys, and for HCL Tech, Wipro, it's broadly in that band of 20 to 22 times. Now, in a nutshell, if you have to summarize, the NSE IT index has recovered nearly 24% in the past 12 months, despite no visible pickup in demand. So stocks have run up in anticipation of a demand revival. And I think this quarter, what the street wants to see, if not in the numbers, but maybe in the commentary, we hear from them about a demand revival, which will justify the run up that we've seen in the stock prices.
All right, that's very, very comprehensive, Rima. Thanks very much for that excellent preview of what we should expect from the IT companies for the third quarter. Kawaljeet Saluja is Executive Director and Head of Research at Kotak Institutional Equities, who's watched this space for a long, long time. Kawaljeet, great to have you with us here. And Happy New Year from all of us here to you, your team. So, to your mind, what are the top 2 or 3 things which will be the most important for investors who've been holding stocks or who've been wanting to buy into some of these large cap IT names?
I guess the key thing which everyone will be focused on is on revenue acceleration in FY25 and whether there are any clear signs of visibility of that acceleration. Now, 2 things will give you that visibility. One is, essentially your improvement in discretionary spending. Let's say if companies indicate that discretionary spending, budgets have closed, they are looking all right, then that will give confidence. Though knowing companies, typically in the month of Jan, they do not say a whole lot. And second would be mega deals, large deals, or your TCV numbers, which we expect to be fairly muted for this quarter. So I don't think that there'll be anything much that will come out from the quarterly numbers to give visibility on calendar year 24 or FY25, which is where people will pick up cues from macros rather than company-specific commentary. If you're looking for positives, then yeah, December would be the worst quarter, so March would be better. At least many of the companies would return to growth, yeah.
Okay, so you're saying that compared to the previous quarter, this one is not going to be as bad. Maybe sequentially things may improve, right? That's the right way to look at it?
That will happen in March. That will happen in March 2020.
In the March quarter.
March quarter, that's right. Yeah.
Okay, got it.
December is
but no one has any expectations from this December quarter either, right? They're all expecting either flat or slightly some amount of pressure, etc. But in the commentary, just to take that point forward, is there any hope for a revival in 2024 that we can expect?
There will be an improvement in the growth for FY25 will be better than FY24. And there are a couple of reasons why growth in FY25 will be better than FY24. First is that companies will get between 2 to 4% of revenues from mega deals. That's something which did not exist or other was not there at the beginning of FY24, but which would be there in the beginning of FY25. Second is that, in FY24, there was unusually high number of program cancellations and reprioritization, of programs, which, the same intensity would not continue in FY25. So I guess, FY25 will be better than FY24. But the key question is that would FY25, be strong enough to meet where the current consensus estimates are, which is, let's say, for tier one companies, a growth rate in the vicinity of around 9 to 10%? I don't think so. So an improving direction, improving trajectory, yet, even with that improving trajectory, there will be revenue and EPS downgrades once this quarterly result season is done.
Okay. Hi, Kawaljeet. Good morning. So maybe another quarter of pain is what we could see before moving on from here. Kawaljeet, if you had to pick a couple of companies, which could deliver a positive and a negative surprise, you could name 2 or 3 companies, from your note this time around, and a couple of factors that we should be looking at as well.
Nigel, if you're putting out a preview, I guess that just encapsulates our expectations. So I guess nothing much would change. But if you're looking at companies with, a reasonably good December quarter, it would be persistent. I think they deliver a fabulous, growth. And then you will have a mega deal ramp-up led growth for HCL Tech, which on a sequential basis will be fairly high at 4.3%. But on a YOY basis, given the product seasonality and the noise, the growth will still be at a moderate 0.8%. But, if you look at the pack as a whole, or let's say the large cap, the fact is that the growth rates have slowed down. So I guess everything boils down to, FY25. What I'm essentially saying is that you will not get enough cues from the management on FY25, and you have to take a call based on macros. And our view is that business will improve for sure, though not to the extent compared to where the consensus estimates are.
Okay, and Mark, consensus expectations are already high, and they'll have to be brought lower even for FY25, as you're saying. Kawaljeet, just a quick word on Wipro, if you can. Should we expect anything there?
In terms of?
Rima was talking about maybe there have been reports of promoters, not very happy with how things have been running there. There have been top management sort of exits, etc. as well. Stock's been an underperformer. Is there potential for some change? Should we hear anything?
Look, I think given the way the company has performed, it's logical. Even the CEO would be not very happy with the way, let's say, the company has, performed. But beyond that, it's just speculation, and I don't want to get into those kind of speculation as such. The fact is that the environment has been challenging, and Wipro's challenges have been amplified by the fact that they have a high exposure to discretionary spending or consulting, revenues here. And let's say if the discretionary spend recovers, then of course Wipro will also be a beneficiary of it. Yeah.
A disproportionate beneficiary? If consulting is I think amongst the large cap IT names, Wipro's got the highest, right? Exposure. So, as you say, you. Okay. All right. Got that. Kavaljit, good to have you with us. Thank you very much for your time, and hope to speak with you once we have the numbers with us for a quick review. Appreciate it. Well, that's Kavaljit from Kotak with his perspective on IT services and the third quarter numbers there. Markets up 120 points. Mitesh is with us to run us through what he's making of the market right now. Mitesh.
I love how you just said, markets are up 120 points. I mean, that's just par for the cause. This 120 points, Prashant, come on.
Okay,
you get some more energy into there.
All right.
No, I'm just kidding.
Mitesh, how are things looking? Good for more, or would you wait for the Nifty to cross yesterday's high before taking a more constructive kind of view, before actually taking a trade, putting in a trade there?
So Prashant, early in the day, the idea was that you will get a gap up, you'll get possibly a 40-50 point kind of dip, which happened. And I think that was the entry point. I still believe that this market is ranged and might see supply around 21,740, but logically 21,800, 820 is the target area. So maybe you'll see some more upward push, if not today, maybe tomorrow, day after. But I think it is still a market which is sideways broadly, and therefore buying near the lower end of the range will always be rewarding. Till that breaks, and then you'll have a minor stop loss to protect your capital. On the stock side, I think LTTS is on the list. That's a buy with a stop below 5,200 for targets of 5,500. And Britannia is something which is turning negative. So a sell here with a stop at about 5,180 for targets of 50-50.
Well, thanks a lot for that, Mitesh. One stock that is just not participating in the rally, in fact, it's under a lot of pressure right now, is Zee. The stock is down 9%. Now, there is a chance that the Zee-Sony merger may not go through because of all the latest developments. If you're not in on the developments, Hormuz is here to give us the latest. Hormuz, over to you.
As you said, there are chances because there's still no certainty there as well. And it stems from a Bloomberg report which came out last evening, which said that Sony is planning to call off this proposed $10 billion merger. And it's planning to send the notice, the termination notice, on the 20th of January. Now, this is a Bloomberg report citing sources. And the merger, as you know, has been in the works since 2021. So there has been a lot of back and forth since then with no clarity emerging. And now Sony is planning to pull the plug. Now, why is Sony planning to pull the plug? Is because they do not want Puneet Goenka to lead the merged entity because of a regulatory probe that is ongoing right now. And again, that is part of the report as well. And we need to ensure that to tell our viewers that CNBC-TV18 has not independently verified this story. Now, what has happened here is that in August of last year, both Subhash Chandra and Puneet Goenka were barred by SEBI from holding any key managerial positions in Zee Entertainment. And this was amidst the fact that SEBI was planning to complete the probe in the next 8 months. But Puneet Goenka appealed against this order, and the SAT, the Securities Appellate Tribunal, overturned the SEBI's ban on this, and Puneet Goenka was reinstated as the MD and CEO of Zee Entertainment on the 30th of October last year. But nonetheless, there is still uncertainty over this deal. The stock is under pressure. This is the biggest single-day drop since April of 2021. But remember, the stock is in the F&O band today, and as a result of this drop, the stock's market cap has fallen below the 25,000 crore mark. Back to you.
Okay, some attempts at a recovery, etc., all sold into and down over 10%, as Hormuz points out. Hormuz, thanks very much for that. We'll take a quick commercial break here. We put the focus on commodities. Manisha is here to help us do that in just a bit.
Welcome back. Let's get a quick handle on what's happening in the world of commodities. Manisha Gupta is joining in. Manisha, what's the one commodity that you're tracking this morning?
Well, I'm looking at the crude oil prices. This is one area where you have seen very strong volatile moves coming in as we start a new year. So last week was 2% of gains, but overnight we've seen 4% of a decline come in for the crude oil prices. So after 10% of decline in 2023, 2024 has begun with a negative move already for the first 9 or 10 days for the crude oil prices there. With the kind of decline that we are working with, we are already trading at around 6-month lows right now. Well, 3 or 4 factors which are putting pressure right now. One is the weak demand that we've seen come in from Asia, including China, and that has led to Saudi Arabia cutting their official price to Asia by $1.5 to $2, and this is the lowest that they've done in 27 months for the Asian consumers in sense of official prices there. And then it also is about the rise in output from OPEC. They have been talking about cuts, but when you look at the month of December, 70,000 barrels per day of an increase is what has been noted. So December output stands at 27.88 million barrels per day. The US drilling also has continued to rise, well, 501 as of now, and a forecast of 20 additional rigs in 2024 continues to weigh onto the markets. Remember, US has been producing record crude oil for the last 4 months now at around 13.2 million barrels. Within OPEC as well, it is higher output from Angola, Iraq, Nigeria. So most of these African countries will continue to produce more. They haven't agreed to a quota agreement from the OPEC there. If you look at the global consumption there, and we have seen a bit of a decline come in for that one. For the month of December, it was a sharp decline at 1.3 million barrels. Overall, for 2023, the 1.8 million barrels per day of a global consumption still stands on a taller side there. The Israel-Hamas war and the Red Sea concerns, Syria output halting, all of that has led to premium in prices. But you have to understand that it hasn't impacted the oil output in any way. And the concern clearly comes in from the demand side of it. Because when you look at the numbers from US, Europe and Asia, the demand has seen a decline in the previous quarter, and that would continue to weigh onto the markets. It also has been about the high US gas inventories. The distillate demand in US is the lowest since 1999, and that doesn't help as well. Add to that the fact that the US dollar index is trading on the higher side. The US non-farm payroll data came in better, and the expectation now on the US Fed rate cut for this current quarter really seems to be waning. It was at 90% by mid-December. It stands at below 60% at this point in time. What the street will watch out for is the EIA short-term outlook in sense of global demand and supply numbers. That is going to be important. And the next OPEC meeting now has been fixed for 1st of Feb. So that's another thing that the street will keep an eye on.
Okay, thanks a lot, Manisha, for that. Let's slip into a quick break on that note. On the other side of the break, our special segment, Outlook 2024. Lata will get chatting with Jahangir Aziz of JP Morgan and Robert Sokin of Citi to discuss their outlook for 2024 and the key growth trends for India and the US. Stay tuned.
The global economy had a much better 2023 than we feared when we began last year. There were fears of steep recession or at least a global and US slowdown. The year actually ended with growth ticking much higher than expected for several large economies, especially the United States and India. In this context, how will 2024 pan out? I have with me two well-known, well-regarded economists, Jahangir Aziz, the global head of economics at JP Morgan, and Robert Sorkin, the global economist at Citibank. Gentlemen, thank you very much for staying up for me, and a very happy new year to both of you. Jahangir, like I said in the intro, we spent 2023 worrying there will be a recession in the US and hence a big slowdown in the world. Now, what's your starting assumption for 2024?
We're looking at a global growth where the global economy is going to slow down. There is no question about that. You're already seeing signs of that. But the slowdown is warranted in the sense that that is part of the soft landing that we're looking for, the disinflation process that will need to happen in order for central banks, particularly in the Fed, to start cutting rates. And if that doesn't happen, then we are stuck with especially the Asian central banks. The Latin Americans have started to cut rates, the Europeans have started to cut rates, but the Asians can't do anything because they have such little margin over the Fed that unless the Fed starts cutting rate, the Asians can't do. However, if you look at the Asian economies, these economies all cannot really survive 2024 with real rates this high. So I think for domestic reasons, they need to cut rates. But that cannot happen unless the Fed starts cutting rate, and therefore the slowdown in global economy is required because that's what's going to keep disinflation on this disinflationary trend.
Okay, got that. Jahangir, stay on. Robert, welcome and Happy New Year to you as well. Well, let me come to the more recent data. Job numbers from the US were very strong. Amid all this talk of slowdown, job numbers are strong. So what are you expecting by way of rate action from the US Fed?
This is a very key question. And even though the overall job numbers were strong in the report in terms of payrolls being expectations, I think we are starting to see a little bit of softness underneath those figures that lead us to believe that the economy is likely to slow down more later this year. Some of those being the more softness in the household employment report, particularly a drop in participation, as well as employment there. We also saw a big drop in the ISM Services Employment Index that came out recently as well, another indicator that things might slow down going forward. So I think right now the economy has been fairly resilient, but there are signs they're going to start to worry the Fed that the economy might slow down. And what that might mean is from their communication, we're hearing that they're being fairly dovish and that they want to support the economy and want to avoid a recession. So that might mean in the background, a faster runoff of the balance sheet or a sooner runoff, and maybe faster Fed cuts than we're expecting. We still have them cutting in the middle of this year, but the balance of risks are that they move sooner than that.
Okay, then Robert, what are your own growth expectations for the US? I think the average for 2023 was well over 2%, 2.1 or thereabouts. What's the average for 2024?
I think we are seeing some signs the economy is starting to slow down, but given the resilience we had last year, that forecast, that actual growth you mentioned was way above expectations. You have to mark up the probability of a soft landing pretty significantly. So we're still in the recession camp. We have the economy going into recession in Q2 of this year. So we have 2 quarters of negative growth in Q2 and Q3. So that's going to lead to an annual growth rate that's pretty low given those negative quarters. But and that's a fairly mild recession by historical standards. However, I think the data are telling you that there is a higher probability of a soft landing. Data is also telling you there's a risk of recession, as I mentioned, with the labor market numbers. We're also seeing some other areas of stress, like in lower income consumers are showing some signs of strain. So it's a very difficult time for the economy. And I think the next few months will really tell us whether we should move that base case to a soft landing or whether we should stick at that recession call we have mid-year.
Okay, got that. Coming back to Robert, Jahangir, India's NSO recently has forecast a sterling 7.3% GDP for the current year. Now you tell me what's your estimate for India in FY25, considering that, you are expecting rate cuts and a global slowdown.
So we are expecting the economy to slow down in the first half of the calendar year, which would mean the last quarter of the fiscal year and the first quarter of the next fiscal year. First of all, you are going to see, public investment, which has been a big driver of growth for the last 3 quarters of the fiscal year. In the fourth quarter, will have to slow down if they are to meet the budget target. We are already seeing signs of that on the monthly numbers. And I think that is one part of it. The global economy is slowing down. So services export, which has been the other crucial driver, is also going to slow down. And that we expect to continue throughout 2024 calendar year and for 2024-25 fiscal year. But you're looking at a slowdown somewhere close to about 6.5%. Nothing outlandish. And again, look, these growth numbers that the NSO is producing, these are all in terms of aggregation, let's put it that way, of quarterly numbers. 2 years later, we will get the revised numbers. The quarterly numbers have serious problems with deflator issues. So I wouldn't take this very seriously, but clearly, just by looking at other indicators, from profitability to what's happening to consumption, etc., even though that hasn't been spectacular, the growth rate in India is clearly reasonably strong at this point in time.
Okay. Robert, how will you see US yields shape up? If you are expecting cuts, at the moment their yields are up again at 4%.
As we get closer to those rate cuts, right now there's a lot of uncertainty because the market's already pricing a lot more rate cuts than we have in the near term. As I mentioned, that's entirely possible, but we have fewer than that. But I think the story still is, once the Fed starts to ease, you should get those short end yields, falling quickly in coming years, and you should get that long-term yield probably falling a bit further. I kind of think somewhere in the high 3% range is reasonable for the 10-year. But again, it's going to depend on the Fed posture. And it's going to depend on the speed and extent of those rate cuts. But I think whether those rate cuts happen in March or they happen in July, I think the direction of travel is pretty clear in terms of the shape of the curve over time.
Yeah, that clearly is the consensus. Rates have peaked, no two ways about that. The problem is, when will they start getting lower? Jahangir, what rate cuts are you expecting in India from the Reserve Bank in your 6 to 6.5% assumption, GDP assumption?
So that's where the growth dynamics plays out. So we do not expect RBI to cut rates in the first half of this year. So the first rate cut will be after the Fed has started cutting rates. Our assumption is in June. So clearly it has to be in the second half of 2024, which means that the first part of 24-25 fiscal year is going to still suffer from very high real rates. It's only in the second half, with the rate cuts, you are going to get some boost, which is why growth is going to slow down in the first half of the fiscal year and then pick up in the second half of the fiscal year. That's how you get the 6.5. But we do not expect expect RBI to do on the policy rates. Now, RBI may start moving those emergency tightening measures that they had imposed in the second half of last year, when global financial conditions jumped, when the 10-year rate went to 5, dollar strengthened. I think those have all been reversed. Global financial conditions have eased. So I think that at least on the interbank rate, I think there is significant scope for the interbank rate to go back to the reverse repo rate, to the repo rate. And therefore, on the front end of the curve, there could easily be a rally, but that's largely driven by the tightening measures being reversed rather than any actual rate cut.
Okay, so not factoring too much of a rate cut, but this morning we have even the Bloomberg index likely to include India. That could have something on the longer term. But Jahangir, the softness in India's inflation is very much dependent on the Chinese softer growth. That has helped core inflation stay in check. Now, what's your growth expectation from China? And will this deflationary impact of China on core inflation across Asia continue?
So Chinese growth, again, is a story in two parts, right? In the first part of the year, we do expect growth to be about 5.5. So the first half of calendar year 2024, that slows down to the 4.5 handle. The reason why we have the first half growth at 5.5 is the spillover of that is going to come from the fiscal support that came in 23. It came too late. It came in the month of November. So clearly, it's not going to have much impact in 23. That's going to be passed on to the first half of 24. So it's a 5.5 to 4.5. We are looking at about 4.9%. We are expecting the government to basically say growth will be around 5%. So that's sort of where we're looking at. We do expect the deflation, domestic deflation, to sort of pick up, to end and then pick up, but it's not meaningful. It's like 0.9% for the year as a whole. The part that the rest of the world actually has benefited from, which is the export price deflation, we think that continues. And the reason we think it continues is because policy is still pretty much biased towards supporting industrial production.